Good afternoon. Today is Monday, May 18th. My name is Jon Courtney from Village Wealth Advisors. Today I'll be updating you on a pause in our investment strategy, and I'll be covering the reasons behind that. My agenda of items that I want to cover today is I'll be reviewing what our investment strategy has been and how we've been implementing it. I'll tell you about the economic crisis, both what we've gone through so far and then what I see as the paths going forward. I'll tell you how and why I'm adjusting our investment philosophy. I'll give you a global perspective about what I see are going on around the world and how that affects how I think we move forward. And then finally, I'll share with you what I'm watching in terms of what are the most important factors that will affect how I continue to develop the investment strategy. So first, what has our investment plan been? Well, we started our investment plan about 2 years ago, back in February of 2018, when we began to build a war chest for you inside of your portfolio. I did this because though I didn't know we would be suffering from a viral pandemic, I did know that a recession would happen. It was just a matter of when. And so I began to build up defensive and cash investments inside of your portfolio to both protect you from a coming recession, but also be able to take advantage of any down markets where we could buy low. Now, since this crisis began, we've been doing active rebalancing, both on an ongoing basis, but recognizing that we had to be flexible with the timing of that. We've also done significant tax loss harvesting, saving you in the future lots of money on your taxes. That was completed in March of this year. And then finally, right now and on a continuing basis going forward, we've been using defensive investments to take care of both your ongoing cash flow needs and any on-demand one-time cash flow needs that you might have. Let me talk a little bit more about the war chest. So 2 years ago, we sold 10% of your portfolio from US equities and developed the first part of what I'm calling the war chest. Then about a year ago, we expanded that war chest to a total of 15% of your portfolio. And that's how we were positioned going into this crisis. Then as soon as the crisis hit in March of this year, we put about a third of that war chest back into stocks, buying at pretty much the lowest point that we had seen. And then the plan was to continue to deploy that war chest, buying a little bit from it every single month into the stock market as a potential recovery continued. Let me review with you a little bit about how this crisis developed. Now, you've seen this chart before in previous presentations that I've done, and you know that I've always looked at this crisis in terms of multi-level crisis. So in other words, we started with what I call a level 1 crisis, which was really a supply chain disruption as this virus took hold in China and plane flights and travel and the movement of goods was ceased. We saw supply chains all around the world break down because of that. Then the crisis moved into a level 2 crisis as the virus spread around the world, where we saw reduced worker productivity. That quickly became what is now a level 3 crisis and continues to be a level 3 crisis, where there's been dramatic drops in consumer spending and business investment, both here in the US and around the world. Now that coincided with a dramatic drop in the US stock market, which you see in the blue line here with the S&P 500. So you can see the dramatic drop in the S&P 500 in the latter part of February and throughout the month of March, and then a quick recovery from the lowest levels where we've maintained this approximate 10 to 12% drop in the S&P 500 all through the month of April and continuing into May. Now, the orange line shows you the cumulative COVID-19 cases worldwide. And you can see the dramatic increase in the cases for the point we are at now, which is just sub 5 million cases worldwide. The white line shows you the total cases here in the US, which started going up significantly, are still increasing, though at a slower rate than we had seen initially. That is not what the most experts call the flattening of the curve, though this curve will flatten if the day-to-day active coronavirus cases flatten. That is really the flattening of the curve that has been such a key indicator. But really the question is, where do we go from here? Right now, we're in the middle of a level 3 crisis, and there's two possible paths going forward. One towards recovery and one towards a level 4 crisis. And it's really that divergence that concerns me the most and impacts what the investment strategy should be going forward. So are we headed towards recovery, or are we headed towards crisis? Now, I've described in previous presentations that I expect any recovery that we have to be either U or swoosh shaped. And I've also described for you what I see as a level 4 crisis and what the factors that might drive us into a level 4 crisis might be. But it's really getting to the point where either consumers or businesses cannot pay their debts. And we begin seeing defaults and really a potential spiraling out of control as we had in the Great Recession. Now, this is a chart that will be familiar to some of you. I've highlighted it in past presentations, but we saw the initial drop in the stock market, represented by the dropping black line here, and then possible recoveries, either U-shaped, where we see recoveries take a matter of quarters to happen, to possibly swoosh-shaped, where the recovery takes a matter of years. And I've designed our investment implementation strategy around those two likelihoods, either a U-shaped or swoosh-shaped. So as you recall, 2 years ago, we began to build up a war chest that we could implement for you. On March 20th, we deployed the first part of that war chest back into the market, buying on March 20th, on or about March 20th. We did another deployment on April 15th. And the plan had been to continue that pattern every month, deploying that war chest back into the market. However, based on what I'm seeing in the current economic and market and political conditions, I've decided to take a pause and not do another buy on last week on May 15th. But I do tentatively plan to continue the implementation beginning again in June, depending on how I see this crisis continue to develop. So what are the reasons for me taking this pause? Well, there's 4 factors that I'm most focused on. The first is that unemployment is horrible right now. Unemployment seems to be right around 20%. The stock market, as I've told you in previous calls, I believe is inflated right now. I believe it's based on unrealistic expectations for how the recovery continues. We also, on the positive side, do see states and counties beginning to reopen, which, if everything goes well, will lead to positive economic activity. But if things don't go well, could just exacerbate all of the other negative factors and drive the economy and potentially the stock market lower. Again, on the positive side, there is hope for a vaccine, but I think the timetable, the likely timetable for rolling out a vaccine for COVID-19 is probably measured in years rather than months or quarters. So I don't really know how to feel about all these different factors. You know, on one hand, some of these negative factors could absolutely drive us deeper towards a level 4 type crisis. But some of these factors, if they work out well, will absolutely drive us towards recovery. And so it's that confused state, that mixed emotion that caused me to take a pause and really see which way we're likely to head, so that I know whether I need to defend you against a deeper crisis, or whether I need to deploy that war chest to take advantage of a low market that will drive gains for you into the future. Now, to give you a little bit of a global perspective, I think as we look at COVID-19 as an economic crisis globally, it's probably most useful to focus on the top 5 economies in the world. Now, the top 5 economies are: number 1, the US, representing about 25% of global domestic product; global gross domestic product. Number 2 is China at about 16%. Number 3 and 4 are Japan and Germany, both representing about 6% of GDP each, followed by India at about 5% of global GDP. And so it's instructive to understand how COVID-19 has affected these 5 economies most specifically. Now, focusing on the US, this is a chart showing along the X horizontal axis the number of cumulative confirmed cases of COVID-19 by country. Along the y-axis, up and down, are the number of cumulative deaths from COVID-19. Okay, and then the size of the bubble depends on the population of the country. All right, and the source for this chart is the WHO, but all these numbers were double verified by me against data from Johns Hopkins. So it is reasonable to believe that this information is accurate. And what this chart shows me is that the United States has handled this crisis extremely poorly. We have, compared to our population, we have many times the number of infected, confirmed cases here in the U.S. and many times the number of deaths compared to our peers around the world, both larger in population and smaller in population. I've highlighted a few examples that have been in the news during this crisis. China, which seems to have been the source of the COVID-19 crisis initially, despite a population 3 times that of the US, has had a fraction of the number of cases and deaths that we've had. Italy, which was a initial hotspot of COVID-19, has managed to flatten their curve rather quickly and has mitigated much of the confirmed cases. Their death rate, though, however, was much higher because their hospitals became incredibly overwhelmed very quickly because of the crisis. In the news recently has been Russia, but Russia still has a very relatively small amount of cases, though it does seem to be growing relatively quickly. But really the outlier here is the United States. Now, the reason we care about the rest of the world and not just focused here on the United States is because your portfolio is globally diversified. In this case, I think it's going to add quite a bit of protection to you as we see this crisis continue to unfold. We have about 55% of your portfolio allocated to US stocks and about 45% of that stock piece allocated internationally. And I believe that diversification will really be helpful in the years to come. So looking at kind of the top 5 world economies and rating both their how susceptible they've been to infection and how that has translated to the global to their economic outlook for 2020 and maybe early 2021. Here's how they stack up. The US, which is the largest world economy, has fared extremely poorly when it comes to infection rate of COVID-19. And it is very likely that we see in 2020 and early 2021 a contraction in our economy because of that. China has fared fairly well in terms of infection and is probably likely to squeeze out a little bit of GDP growth this year. They were able, though they got the virus the earliest, they managed to recover from it rather quickly, and will have the remaining part of the year to hopefully squeeze out some economic growth, which will be good for the global economy altogether. Japan has fared fairly well, but is still likely to contract in its economy. Germany and India both fared okay in terms of infection rates, but they are also likely to see contraction in the size of their economies. Now, what I'm watching going forward, probably one of the most important indicators here in the US is unemployment. It's probably the most important factor when gauging whether we're likely to be driven into a level 4 crisis or whether we're likely to recover from this. And I'm going to just read some of the excerpts from a report from the Federal Reserve. This was their report on economic well-being of U.S. households. They just released this in the past week, and it was based on April survey data. So this is very recent information. And what they found from their survey was that about 13% of adults had said that they'd lost their jobs in March of 2020, with another 6% reporting that their hours had been reduced or they were on unpaid leave. So that's how we get to that 20% unemployment estimate. Now, this is a very positive, bright spot, and that is, of those who said that they lost their jobs in March of 2020, 91% of those people said that they anticipated returning to work to either the same employer or indicated that they had already returned to work. That's a very high percentage and is a good indication that we might very quickly bounce back from this crisis. Now, it is important to realize that this was a survey of employee opinions, not employer opinions, which would be extremely informative, but we just don't have data on yet. Now, this is another area of concern. 18% of adults said that they didn't feel that they were able to pay their April bills because of the crisis. And then among those who said that they had lost their jobs or had reduced hours, a third of those did not expect to be able to pay their bills in full in April. Now, this is where buying time really comes in and is really crucial. And this is where the U.S. government has been integral in stemming the crisis, spiraling deeper. The CARES Act and the economic stimulus that we've gotten from both the U.S. Treasury, from Congress, and from the Fed have been buying us time through this crisis, allowing both consumers and households and corporations to continue to pay their bills, buying us another month, another 2 months, another 3 months to get through the crisis. It's my estimate that based on the stimulus we've already received and has already been approved, we probably have until about July 1st to get economic activity up before we face another round of economic crisis without another stimulus package. So as we get into June, if it's clear that the reopening of states has not been successful, that cases of COVID-19 are growing because of the reopening, and it looks like we're going to have to quarantine again, another round of stimulus is going to be necessary to buy us more time beyond July 1st. Otherwise, there will be concern of a spiral into a level 4 type economic crisis, where we're worried about a global or U.S. debt crisis. Now, one thing I want you to keep in mind is that strategy is really just one part recognizing where we're at right now. And it's two parts recognizing where we're going. And so as I begin to adjust our investment strategy and adjust how we implement it over time, that's what I'm going to be focused on, is really two parts. Where are we going? Are we headed towards recovery, or are we headed towards a deepening crisis? And this pause in the investment strategy for May is going to give me a little bit more time to kind of see where I think we're going. I will continue to keep you updated of exactly that as things change, either through these Zoom calls or through recorded messages. And as always, if you have any questions, if you need help or want to understand how this crisis is affecting your situation specifically, please reach out. My team and I are operating at full speed right now. We are actively looking for ways to protect you against the worst parts of this crisis and take advantage of the opportunities as they come along. And if you have any friends, family, or coworkers that need help, who are confused, who need good information, please do forward this video to them. And I can be reached here at john@villagewealthadvisors.com and also through our website, Village Wealth Advisors. Please call, happy to help. Take care, and I look forward to the next time we talk.